Welcome to the September 1st, 2025 Advanced Report for McGowanGroup clients and NetWorthRadio.com listeners. We've got an important update today, and we're going to go with asset classes. I'm going to give you some things that are changing in the market over the next 18 months, and also portfolio construction outside of the normal discussion of whether we should buy NVIDIA or not. NVIDIA reports a 56% gain in profit and sales. That was magnificent. And of course, they went down 5%. What happened? It's called price for perfection, meaning the expectations are so high, they're going to be very hard to meet and exceed. That's happening all over technology right now. So let's talk about different asset categories as the Federal Reserve, clearly indicated by T-bills this week, coming down in yield, even though the rates haven't changed yet. They're telegraphing the Fed is going to start to cut now that Jerome Powell got in trouble for his $3.1 billion renovation, which cost $6,800 per square foot, and it cost 6 times as much per square foot as a new build for JP Morgan's Manhattan headquarters. Also cost $3 billion, but they got 2.5 million square feet. But anyway, the whole perspective is changing. Rates are likely to go to the current inflation rate, which is just below 3. That would be 5 or 6 interest rate cuts. Now, at the same time, everybody's focused on growth with innovation. If you do any financial media, you're going to hear a discussion about why you should pay 100 times earnings for Palantir or whoever. And the problem with that is if the growth rate's slow, they're going to take that multiple down, which means that the stock would go down. So what other categories are there that people haven't thought about? Well, growth with income. We're going to get to that. That's the dividend companies, and it's referred to as the value sector. So Jeremy Grantham, actually GMO, big money manager, manages over 100 billion. He does a 7-year forecast. He said this category over the next, and this is real return, so he's subtracting inflation, over the next 7 years, minus 5% per year. This category, growth with income, the value sector, he said a plus 5% real return for the next 7 years each year. And what's this? Well, that's affectionately referred to as junk bonds, global lending. You look inside a bank portfolio, there's loans and bonds. Tactical safety. What you're not hearing about is maybe it's time to take a little off the table, build some safety reserves, because usually market corrections are from some unexpected event or something that surprises everybody to the negative side. And it's best to build the tactical safety when you make new highs. So this week, S&P 500 making a new high. Notice the value index has lagged really since 2022. The growth index took off. That leaves some bargains. And we're finding them, by the way, in McGowanGroup portfolios. I'm Spencer McGowan, President, McGowanGroup, your financial weatherman with your weekly update. And I'm giving you thoughts on the market and portfolio construction. I know bonds are boring, but I'm going to spend some time on that too. A good dividend company, that may sound boring, but S&P 500 this week makes an all-time new high at 6,500. Wow. And with the news that Jerome Powell from Jackson Hole said, hey, it's probably about time to cut rates, or however he said it in Fed speak language, put the Dow 45,800 at the all-time new high, settled back a little bit, but the Dow holding as well. What did not make a new high? Oh, the NASDAQ 100, which is very tech heavy. Wow, what is that telling us? There's a shift. The money flows look like they're more to value, at least this week. And that says there are some great bargains out there in high dividend companies. Now, if we look at what happens in the next correction, you always want to be prepared, and reliability, and you look at parts of the bond market, the high yield market above 7%, that's B-rated corporates with a good manager, net 7%. That's 35% over the next 5 years, and it comes in pretty close to the value index too. Those are two good categories for more reliability, where we're not worried about tech companies going from 100 times earnings down to 50 or worse. All right, earnings are just fine, 12.38%. There was big news this week that most people missed, and that is economic growth for the second quarter revised upward to 3.3%. That is 50% higher than the average growth rate the last 20 years in the economy. So everything is still just fine. But we're starting to see signs that some things may be overpriced. And that says you start to emphasize other things in the portfolio, like tactical safety, like the high yield market, well-managed B-rated corporate portfolios, and at the same time, we're finding great dividend companies. And the investment committee meeting once a week, we shift the managed portfolios automatically, especially when we get sell-offs. Thank you for tuning in. We'll be back next week. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.